Have you heard the radio ads about how you can use a type of insurance product to self-fund a car, college, or your retirement tax-free? Get the facts on today's Money Talk.
Welcome to this episode of Money Talk with John and Lorraine McCoy, your money team, registered representatives and investment advisory representatives with McCoy Wealth Advisors.
Recently, there's been a lot of radio buzz about how you can use your own tax-free funds to buy a car, pay for a child's education, and your own retirement. The phrase they use, I believe, is you can bank on yourself.
Well, what exactly is it and how does it work?
Well, it's not new. It's been around for a long time. It involves using the cash accumulation in life insurance. But first, the primary purpose of a life insurance policy is to provide a death benefit to designated beneficiaries when the insured person dies. The cash buildup, or cash accumulation, is also called a living benefit, is secondary.
Yes, it's a strategy where they take a type of permanent life insurance that offers not only a death benefit, but it also pays interest and dividends into a cash account within it. Over time, that cash builds up, and then you can use that cash to make tax-free withdrawals and tax-free loans.
However, if used incorrectly, the withdrawals or loans can lose their tax-free status. If you allow the policy to lapse, for example, or just simply cash it out, it'll lose its tax-free advantage. This means that the cash buildup will be taxed as ordinary income. How do you know if this is right for you? There are three questions that we have to ask. First is, what is the cost of a life insurance policy? All life insurance products have internal charges such as mortality and expenses. Depending upon the underwriting, these policies can cost thousands of dollars in premiums each year to overcome the cost of insurance and to allow the cash to build up.
Now, understand that the healthier you are and the higher the insurance will rate you, the lower is going to be that cost of that insurance. Now, the second question you want to ask is, what are the costs for interest and dividends? What's the rates, I mean? They vary from policy to policy, but what's important about it is they impact how fast that cash value is going to grow. Now, the lower the interest rate, the longer it's going to take for that cash value to build up.
The third question is, will you need the cash in the next few years? There may be surrender charges on the policy if you try to take the cash too soon. The second is that it may take years before you reach the break-even point on the cost of insurance, and even longer for the cash value to build up. So,
in summary, the three questions are, what is the cost within the insurance for the insurance? 2, what are the dividend and interest rates? And 3, is there any chance that you're going to need that cash within the next few years?
Do you have more questions? Ask us.
We know the answers and we welcome your questions. So contact us at McCoyWealthAdvisors.com. Thank you.
Thank you for watching this episode of Money Talk with John and Lorraine McCoy. For more information, visit their website at www.mccoywealthadvisors.com. Also browse the other shows found right here at Columbus Biz TV Shows.